Australia AASB 15 Revenue, the complete masterclass. Hello and welcome to CandiMentor. Today, we decode Australia's AASB 15, the revenue recognition standard that governs how Australian companies recognize revenue from customers. AASB 15 mirrors IFRS 15 almost word for word, with Australian regulatory expectations layered on top. Before we dive in, hit subscribe to CandiMentor. The purpose of AASB 15, Australia's revenue backbone. AASB 15 is Australia's adoption of IFRS 15. It uses a principles-based model built around the transfer of control rather than risks and rewards. ASIC, Australia's corporate regulator, places emphasis on clarity of performance obligations, contract combination, and judgments around variable consideration. A simple way to frame it, AASB 15 ensures revenue reflects the transfer of control and the economic substance of the promises made to customers. The five-step model, Australia's core framework AASB 15, follows the same structure as IFRS 15. 1. Identify the contract. 2. Identify the performance obligations. 3. Determine the transaction price. 4. Allocate the transaction price. 5. Recognize revenue when or as performance obligations are satisfied. This step-by-step approach ensures consistency across Australian industries, especially in complex sectors such as telecom, construction, and mining services. Step 1. Identifying the contract. Australian nuance. A contract exists when it has approval, commercial substance, and collectability is probable. In Australian practice, collectability is a key focus because of strict credit risk rules under AASB 9. Contracts may require combination when negotiated together or priced interdependently, especially in telecom, mining services, and construction. Example: an Australian NBN broadband provider selling hardware plus a service plan. These may need combining if structured to work together. Step 2. Identifying performance obligations. A performance obligation is a distinct promise to deliver goods or services. A good or service is distinct if the customer can benefit from it on its own and if it is separable within the context of the contract. This is a frequent area of ASIC review, especially for software companies, education providers, and telecom businesses. Example: a Sydney tech company sells a license plus implementation under AASB 15. These are usually separate performance obligations unless implementation significantly customizes the software. Step 3. Determining transaction price. The transaction price includes both fixed and variable amounts. Variable consideration includes rebates, bonuses, volume discounts, liquidated damages, penalties, and frequently appears in Australian construction contracts. Choose a method based on the nature of variability. Expected value, when many scenarios exist. Most likely amount, when outcomes are binary. Apply the constraint and include only the amount unlikely to cause a significant reversal. ASIC closely monitors variable consideration treatment in industries like construction, mining services, and large-scale infrastructure. Step 4. Allocation using SSP. Allocate the transaction price based on standalone selling prices. If SSP isn't observable, use adjusted market assessment, expected cost plus margin, or the residual method. Australian companies often use expected cost plus margin for long-term service arrangements because SSPs are not always available in unique project-based industries. Example: contract price equals $150,000. Engineering SSP equals $80,000. Inspection SSP equals $40,000. Allocate proportionally using SSPs. End. Step 5. Revenue recognition. Control transfer revenue is recognized when control transfers, either over time or at a point in time. Overtime recognition applies when the customer receives benefits as work occurs, the customer controls the asset being created, or the asset has no alternative use and the entity has a right to payment. Progress is measured using output methods such as milestones or input methods like cost to cost. Australia's construction industry uses cost to cost extensively, but ASIC expects strong evidence that cost to cost genuinely reflects performance. Variable consideration. Deep Australian examples. Australian mining and construction contracts commonly include milestone bonuses, weather-related penalties, liquidated damages, commodity-linked price adjustments. Example: bonus $50,000 with 40% probability gives an expected value of $20,000. Under AASB 15, include the amount only if the risk of reversal is low and evidence supports the estimate. End. Contract assets and contract liabilities. AASB presentation. A contract asset arises when performance exceeds billings. A contract liability arises when billings exceed performance. Australian auditors test whether rights to invoice have become unconditional, whether the contract asset needs impairment under AASB 9, whether roll-forward schedules match financial disclosures. Example entry: full debit, contract asset; credit, revenue, when invoiced; full debit, accounts receivable, credit, contract asset. Principal versus agent. Control model AASB 15 uses a control-based model identical to IFRS. Indicators include inventory risk, pricing discretion, and responsibility for fulfillment. This is important for travel agencies, online platforms, marketplaces, and major Australian retailers. Misclassification is a significant ASIC concern. Contract costs. AASB 15 Section 99 Guidance. Capitalize. Incremental costs of obtaining a contract, such as sales commissions. Costs that fulfill a contract and generate peer-enhanced resources. Amortize these costs over the period of expected benefit. Australian companies frequently capitalize bid costs in long-term construction and service contracts, provided they are recoverable. Example: full debit, contract cost asset; credit, cash amortization. Full debit, amortization expense; credit, accumulated amortization, contract costs. End. Contract modifications, a common Australian scenario. Contract modifications are common in infrastructure, telecom, defense, and mining projects. Assess. 1. Does the modification add distinct goods or services? 2. Is the pricing consistent with SSP? If yes, treat it as a new contract. If not, adjust the existing contract using cumulative catch-up or prospective treatment. Example: a mining services company increases drilling scope mid-contract, requiring remeasurement. End. Licensing, IP, and SaaS. Australia's tech sector licenses fall into two categories: right to use intellectual property, point-in-time recognition; right to access intellectual property, recognized over time. Australian SaaS businesses often bundle hosting, updates, and support, making most licenses right to access. Education providers offering long-term digital learning platforms follow similar principles. Warranties and service obligations. Assurance warranties are recognized as expenses. Service warranties are separate performance obligations and recognized over the service period. Australian automotive, retail, and appliance sectors frequently analyze this distinction. Bill and hold arrangements, ASIC scrutiny. AASB 15 allows revenue before delivery only if the customer has control. A substantive reason exists. Goods are identified. Goods are ready for delivery. The seller cannot use the goods for other purposes. ASIC has raised concerns about premature recognition in Australian bill and hold cases. End. Upfront fees. Telecom and education examples. Upfront fees rarely form separate performance obligations. They are generally allocated across the service period. Example: a telecom provider charges a connection fee. It is recognized over the contract term. Education providers charging enrollment fees use the same approach. Breakage. Unredeemed rights. Breakage occurs with loyalty points, prepaid cards, vouchers, and data packs. Estimate expected breakage using historical patterns and recognize proportionally as obligations are satisfied. ASIP expects well-supported breakage estimates. End. Disclosures. Australian regulatory expectations. AASB 15 requires disclosures covering disaggregated revenue, contract balances, remaining performance obligations, significant judgments, variable consideration methods, contract costs and amortization patterns. ASIC regularly challenges weak SSP justification, poor disclosure of modifications, insufficient detail for long-term contract revenue. Australian industry scenarios deep dive. Construction and infrastructure, cost to cost dominates. Modifications, penalties, scope changes, and weather impacts are common. Mining services. Variable consideration, milestone-based payments, and indexation clauses appear frequently. Telecommunication. Bundled handset and data plans, plus upfront activation fees spread across contract life. Education. Digital platforms, SaaS-based learning environments, multiple deliverables, and enrollment fees. Software and SaaS licensing, classification, hosting, implementation services, and upgrades. Retail. Loyalty programs, gift cards, returns, and breakage. Numerical examples. AASB 15 walkthrough. Example 1. Allocation. Contract price $1,000. Hardware SSP $700. Service SSP $300. Allocation. $700 to hardware, $300 to service. Example 2. Variable consideration. Bonus $100 with 40% probability. Expected value equals $40. Recognize only if reversal is unlikely. Example 3. Overtime cost to cost. Contract price $100,000. Expected cost $80,000. Costs incurred $40,000. Progress equals 50%. Revenue equals $50,000. Journal entries. Full debit credit. Narration contract asset creation. Full debit contract asset. Credit revenue. Billing. Full debit accounts receivable. Credit contract asset. Cash collection. Full debit cash. Credit accounts receivable. Upfront fee recognition. Full debit cash. Credit contract liability. Subsequent recognition. Full debit contract liability. Credit revenue. Capitalizing commissions. Contract cost asset. Credit cash. Amortization. Full debit. Amortization expense. Credit. Accumulated amortization. Contract costs. Practical learning tips. Start with the 5-step model. Keep ASIC focus areas in mind: variable consideration, modifications, and disclosure. Use small Australian examples like telecom bundles, mining contracts, and construction projects. Walk through the logic step by step. Add short numeric illustrations to anchor understanding. Make judgments clear and transparent. End. Final wrap. Always connect the explanation back to the 5-step model. AASB 15 mirrors IFRS 15, but Australian regulators place strong emphasis on transparency, documentation, and consistent application. Explain the contract, identify obligations, estimate the transaction price, allocate it correctly, and recognize revenue only when control transfers. State assumptions clearly to maintain credibility. If you learned something today, subscribe to CandiMentor. We are building the world's best learning hub for accounting and finance, and you should be part of it.